We are in a period, we think, where average hourly earnings on a year-over-year basis are still falling in the 2.5% to 3% range in real terms, taking account of inflation. We also got another number today, ISM for the service sector. It's an index that is a diffusion index where anything below 50% suggests that the economy is contracting. And the most important number in that report was orders, always is. Orders dropped 10 percentage points, very sudden and very rare for this index, turning a little bit more negative. The orders number corroborates what we saw from factory orders for the month of November. They were down 1.8%, and even more important, the previous month was revised down from plus 1% to plus 4%. So again, at turning points, we look at revisions. And while we think that when history is said and done, the recession started at toward the beginning of this past year, most statistics are still conflicting, and so that's why I'm saying at turning points. The other notable stats we got include the trade balance. Now, GDP has been stronger than expected. One of the major reasons for it is a collapse in imports relative to exports. So imports subtract from GDP. So if their imports dropped 8%. So if you subtract that, you're really adding to GDP. What is this saying? This is saying that we are cutting back on inventories, much of them coming from China. I think in the import report, consumer was the biggest fall off, and that would be associated with China. Exports fell, but not as much as imports. And therefore, the trade balance improved, and that's going to help economic activity. But it's not for a very good reason. If you think about this, exports down 8%. That's not year over year. That's a month to month. You know, that's like 100% annualized percent decline. Almost. Well, that's an exaggeration, but almost. So that's a very big drop and a big hit to China and other economies, I would suggest. Another curious report in this last month is consumer credit, consumer installment credit. Now, I've mentioned this also before. We're seeing huge increases in consumer installment credit, the net change. 25 billion plus. Now, this is very unusual, except during periods when consumers are stretching. Consumer saving rate has dropped to 2.3%. It's very low by historical standards. It doesn't go much lower. And so what is the consumer doing? It is that the consumer is buying more necessities, probably on credit cards, on installment. And that will continue to drive the saving rate down. So the saving rate is simply disposable personal income, which I just mentioned is diminishing in terms of its growth rate quite significantly, minus consumption. And so goods bought on debt subtract from savings. We got some bad sales indicators in the month. Retail sales down 0.6% for the month of November, going into the holiday season. We got some reports. We'll see what happens when the numbers are completely tallied, but it looks like online spending might have been down, negative. Certain categories certainly were down, and that will be a first in the history of online. So the real average hourly earnings dropping on a year-over-year basis is having an impact. Housing is also not showing any let-up. The only relief was in new home sales, up 5.8% month to month. But I'm sure that a lot of builders facing higher interest rates do not want to carry these homes anymore, particularly if they're spec homes. So they're pushing them out, perhaps with lower prices. But pending home sales are down 38% on a year-over-year basis. Now, in terms of market indicators, some very interesting ones. Let's start with equities and let's summarize the year. If you owned energy, which was up 59% last year in the equity market, you did very well. And as you know, we don't own energy. In fact, we're very negative on energy, certainly from a secular point of view. And now I would submit a cyclical point of view. Prices peaked in March at 130. They're down to 74, West Texas Intermediate. And yet the sector indices for energy sector index is reaching for its all-time highs. And if I look at this chart and from a long-term point of view, what I am seeing is a triple top in I think it was 2015, and now in 22. I'd be very surprised if it gets to a new high because the fundamentals are deteriorating. Demand destruction is real. China, some of the numbers that have been coming out of China are astoundingly weak. And of course, zero COVID is a reason for that. But I do believe China's been building inventories. And the reason it has been doing so is it's using the Russian war. It is buying oil from Russia at significant discounts. And we don't know how long this window will be open. The discounts reports are in the 30 to 40% range. So we would not be surprised to see inventories much higher almost everywhere in the world because of the war in Ukraine and the fears about not getting energy supplies, and China and India buying disproportionate amounts of oil from Russia. Russia doesn't have very many other places of size to sell that oil. Now, in terms of demand destruction, something interesting is happening here in the United States and probably elsewhere in the world. Many of you may have had this same experience. I was in California for the holidays, and I was taking Ubers. 3 Uber drivers were in Tesla cars, and I was asking them about Tesla. I found that curious. And they said, oh, yeah, we're renting our cars from Hertz. Hertz is now not charging us as much to buy or to rent a Tesla. And of course, that's the preferred car. And later on, we learned from Hertz that Hertz is doing this because it has learned that maintenance costs for a Tesla, and I'm sure other electric vehicles, are 50 to 60% below maintenance costs for gas-powered vehicles. Now, the reason this is important is because of a metric we monitor called electric miles traveled. Now, Uber drivers are going to travel many more minutes of the day or hours of the day than we are in our personal cars, which we just park and leave as we go to work. So what this means is the number of electric vehicle miles traveled is starting to increase much more rapidly because of this Uber phenomenon, and sooner even than we might have expected. It is also very interesting to note that oil demand seems to have peaked in 2019. There has been a lot of demand destruction based on rising prices around the world.